So let's talk about money. It's this thing we all use every single day. But have you ever stopped to think about what it actually is? Is it the paper in your wallet, the coins, or the numbers on your banking app? Well, yes, but also no. At its core, money is a shared agreement. We collectively agree that these pieces of paper, metal, or even glowing numbers have value. They let you trade them for, say, a delicious pizza, or a ticket to the movies. It's a system of trust that, for most of history, rested with governments and banks. They print money and keep ledgers of who owns what. We started with barter, then commodities like salt, shells, gold, and silver. Paper money became IOUs from banks, and now most money is digital entries in a bank's ledger. But trusting a central authority means you must trust they won't print too much or lock your account. Trust they'll keep it secure and let you send it when you want. But some asked, what if money didn't rely on a central authority? What if trust could be shared by everyone? And that is where our story really begins. Alright, so if traditional money trusts a bank, cryptocurrency asks, can we do this with math instead? It's not printed by a government and not held in a traditional bank account. The crypto comes from cryptography, the science of secure communication. So basically, cryptocurrency is secure digital money. It exists only in the digital world, protected by complex codes and puzzles. It's the internet's native currency. The most famous cryptocurrency is Bitcoin. Back in 2009, Satoshi Nakamoto published the blueprint for a peer-to-peer electronic cash system. The goal? Let one person send money directly to another online without a middleman. No bank, no credit card company, no intermediary needed. When someone sends Bitcoin, the transaction is broadcast to a huge network of computers. These computers verify that the transaction is legitimate. It's like instead of whispering to a banker, you shout it to a crowd that checks your work. Crypto is digital, global, and runs on a network of users. This massive shift is powered by a new technology called the blockchain. So how does this all work without a bank keeping track of everything? How does the network know you actually have the Bitcoin you try to send? Think of the blockchain as a special shared digital notebook. Every person on the network has an identical, self-updating copy. When I send Bitcoin, the transaction is announced to everyone. They check their copies to confirm I own the funds. If the crowd agrees the transaction is valid, everyone adds the new line to their notebook simultaneously. It's like a global synchronized note-taking session. After many transactions, a page fills and bundles into a block. That block is sealed with a complex digital lock and chained to the previous block. This creates a chronological chain all the way back to the first transaction, hence the name, blockchain. Unlike a private bank ledger, this public notebook is transparent. Anyone can look. We don't need to trust a bank. We can trust the shared, verifiable record. This shared notebook, the blockchain, is the breakthrough enabling decentralized trust. Okay, we have a public notebook that everyone shares, but can't someone just change their copy and write, Sarah sent me 1,000,000 Bitcoin? Each block is sealed with a cryptographic puzzle, a very complex lock. Solving the puzzle seals the block. This is called mining and it needs huge compute power. Each block includes a fingerprint of the previous one. Change one old transaction and the fingerprint changes, breaking the next block's seal. This cascades forward. You'd have to redo every block that came after. You'd need to outcompute the rest of the entire global network. We're talking thousands or millions of computers, an astronomical amount of power, like trying to win a shouting match against an entire stadium. Practical cheating is near impossible. That's why the chain is called immutable. If someone tampers, the network sees it and rejects the fraudulent chain. Security doesn't come from secrecy, but from being public and cryptographically chained. Honesty is the most computationally efficient strategy. It's security through mass collaboration, a profound idea that underpins blockchain. Both your bank account and a Bitcoin wallet can hold digital money, but they work differently. Let's break it down. Your bank account is custodial. The bank holds and controls your money. A Bitcoin wallet is non-custodial. When you own Bitcoin, you control the keys. Private keys are long, secret codes, like a super password that gives access to your funds. No one can freeze your crypto. The network is open 24/7. Bank transfers go through intermediaries and can take days. Crypto moves wallet to wallet on a peer network. Confirmations can arrive in minutes. Lose your bank password and customer service can help you recover access. Lose your private keys and there's no hotline. Your funds can be gone forever. Crypto is empowering, like being your own bank. But it means great responsibility. It gives you sovereignty over your money. Because the network never sleeps, transactions are possible anytime, anywhere. Different systems, different trade-offs, custodial convenience versus non-custodial sovereignty. Why has this technology captured so many imaginations? From visionaries to everyday investors, many see potential. One big promise is financial inclusion. Billions lack banking but have smartphones. Crypto offers global financial access with just an internet connection. Another benefit, faster, cheaper cross-border payments. For migrants sending money home, lower fees mean more reaches loved ones. Public ledgers enable auditability that can reduce corruption. Imagine tracking a government or charity budget from source to destination. People like the idea of shifting power from big institutions back to individuals. Crypto gives individuals more direct control over value and data. We're in an age of experimentation. Many projects will fail, but some may change systems. From NFTs to DeFi to supply chain tracking, blockchain use cases are broad. It's a movement as much as a technology, driven by ideals of democracy, resilience, and new economic tools. Now, we have to talk about the other side of the coin. The world of crypto is not all sunshine and rainbows. The most famous risk is price volatility. Big swings in value can happen fast. What's worth a lot today could be far less tomorrow. User experience and endpoint security are real challenges. Exchanges and apps can be vulnerable to hacks and phishing. People can be tricked into giving away private keys. If your keys are gone or stolen, there's often no recourse. Bitcoin mining uses a lot of electricity, comparable to small countries. Many are working on greener solutions and alternative consensus methods. Regulatory uncertainty remains, rules can change quickly. There are also concerns about illicit use, though public ledgers can help investigators. This be-your-own-bank responsibility can be daunting for newcomers. High ceiling, rocky floor, high risk, high reward. Be cautious, do research, and protect your keys. So what does the future hold for crypto and blockchain? Will we all buy coffee with Bitcoin in 5 years? Maybe, but probably not. Many expect a future where fiat and crypto coexist. Crypto might act as digital gold or a specialized tool for certain uses. The bigger revolution may be the blockchain itself, a secure, decentralized ledger with many uses. Secure voting, supply chain tracking, and user-controlled digital identity are possible applications. We already see NFTs giving artists new ways to prove ownership and earn royalties. DeFi experiments try to rebuild financial services without banks. This feels like the internet in the early 1990s. Clunky, experimental but full of potential. Many innovations are in labs and startups. Some will fail, some will scale. If successful, blockchain could reshape parts of finance, logistics, and data ownership. The future isn't here yet, but we are building it, one block at a time. Okay, let's zoom out and recap. Money is a system of trust. Crypto asked, can math build trust? Cryptography builds secure digital money. The blockchain is a public ledger, chronological and tamper-resistant. You control your keys. Great power and responsibility. It can empower the unbanked and speed cross-border payments. Risks, extreme volatility, scams, hacks, environmental and regulatory challenges. High ceiling, rocky floor. Know the risks before you engage. Whether crypto becomes mainstream money or a niche asset, blockchain opened many possibilities. Understanding it is the first step to seeing where it fits in our shared future. Quick recap, money equals trust. Crypto is digital money. Blockchain is the public ledger. Your keys control your funds. Thanks for watching.